And we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for a special Sunday morning live stream with the precious metals maven himself, Andy Schectman. Andy, thanks so much for joining us, my friend.
Good to be here. Thanks for having me.
You're very kind to do this, Andy, and we got a lot to talk about. First, I just want to apologize to our live viewers. We're starting a few minutes late. That's totally on me. I sent Andy the wrong link by accident. It took us a few minutes to work that out, but we're just a few minutes late here, so we'll still get the full hour in. Andy, also folks too watching, I think I might have said in yesterday's weekly market recap at Lance that today's video was going to be the video on China with Peter Alexander. Obviously it's not. We're here with Andy to talk about the precious metals. That video is going to come out on Tuesday. Andy, I do just want to flag for you real quick. I don't know if you're familiar with Peter Alexander. He is a longtime China expert. He's a Westerner who's been living in China for 30 years. Luke Groman put him on my radar as his China expert. And we do in that discussion talk in a fair amount of detail about how he sees China building a basically gold-backed renminbi settlement currency, and how that basically gives the Chinese government an incentive for the price of gold to rise. So I think both the viewers are going to find that really interesting, but you might find that section particularly interesting as well. All right, so folks, we're going to have our usual talk with Andy about what's going on in the precious metals. Andy, you're going to be speaking at Thoughtful Money's spring conference in just a week, and I was going to try to give you a break between now and then, but of course the world keeps making things that we need to react to, and obviously since the last time we talked, the U.S. has gone to war with Iran, and I think I reached out to you to schedule this live stream when Iran started basically sending ballistic missiles against some of the oil infrastructure of its neighbors in the Gulf. Since then, Iran has choked off the Straits of Hormuz. Then we've gone in and we've basically blown up the military installation on Karg Island, which is its key oil exporting distribution center. And so obviously the price of oil has skyrocketed. Global tensions have gotten even higher in the past couple of days. And the big question is all of this going to spill over into the precious metals market and eventually start causing a flight to safety there? Now, we haven't seen gold, rise dramatically since this outbreak happened. It hasn't fallen super dramatically either. It's still above $5,000 an ounce. But what are you seeing about the war's implications, if any, for the prices of the precious metals here?
Well, I think it'll definitely have an impact. And, it's interesting, the counterintuitive nature of it, because, excuse me, most people would expect in this environment for gold to have taken off immediately. And my dear departed friend, Jim Sinclair, used to say to me, Andy, it's called MOPE, Management of Perception Economics, that they want to manage the perception. They don't want to let gold go to the moon. That would signal the wrong thing and would exacerbate their problems financially. Whether or not people want to acknowledge the fact that these markets are managed by inside interests, I'll tell you that every single time I've seen war, and I've been doing this all the way back to the Gulf War, the very first one, I don't know, in the 90s, every single time this happens, the price gets knocked down into the war. And, the conventional wisdom, it's throwing out the baby with the bathwater because it's very liquid. I think it's more along the lines of managing the perception of what is exactly happening. But what we are seeing happening, of course, is a major shock on oil. And as oil gets more expensive, you have to understand that the dollar still is the world reserve currency, meaning every nation on earth needs to accumulate dollars in order to buy oil. And in accumulating dollars, the place to put those dollars, rather than leaving them in some account, would be to recycle them into U.S. treasuries, which are immediately liquid. And you have to ask yourself, what happens when these nations realize that not only has the dollar gotten stronger for some reason, but so too has the price of oil been going up. These are both moving up in tandem, which is certainly a strain on the bond market. And we are seeing, and Luke Groman talks a lot about this, since you mentioned Luke, you're seeing interest rates on the 10-year start to move in the wrong direction. You're starting to see, I believe, a crack in confidence in the entire system, but you're also beginning to see a form of forced liquidation of U.S. Treasuries simply to get enough money to buy oil. As both are moving up in tandem, and to secure oil is something that will never go away in terms of concern by these nations. So ultimately, I think we are witnessing a situation where this entire system is being looked at cross-eyed, and ultimately, I think you see precious metals moving up much, much higher. But we'll have to see how long the strait is closed. We'll have to see how this all ultimately plays out. But it goes also very much into what you were saying about your guest who's going to come and talk about China. I couldn't agree with what he's saying anymore. I mean, you have a series of vaults that are being built by the Chinese all around the Belt Road. The first one was just completed in Shanghai. I mean, excuse me, in Hong Kong, which is very important, because when gold flows out of China, it has to go out of Hong Kong. The next one is being built now in Saudi Arabia with the intention of building them all around the world. They are building a gold-dominated infrastructure. Ultimately, gold will move regardless of what we see here. And in my mind, this is a temporary strengthening of the U.S. dollar because of oil going higher, because of the dollar being where it is, and the fact that these folks will have no choice, I think, around the globe but to sell treasuries to buy oil. This is a game that you can see is getting close to the end, and will put strain on everything in the marketplace. But ultimately, I think, will be wind at the back for the gold market. Maybe not today, maybe not tomorrow, in terms of the immediacy of rising rates and what's happening, but I think ultimately gold will be one of the biggest beneficiaries of a system that is looking at the dollar and the treasury as something that it really never was, and that is something that isn't really trusted globally anymore.
Okay. I talked about, or Peter Alexander mentioned the new network of vaults that China is building, around the world, outside of China. And it probably doesn't come as a surprise to folks, but the main reason why I said that is okay, so you have a currency, a settlement currency that can be converted into gold, on demand, right? But and it probably will, because a lot of people don't want to hold renminbi, right? It's not as the confidence in that currency isn't as high as it is in the dollar, which is one of the reasons why they're backing it by gold. But also your confidence in storing your gold in China. China understands a lot of players aren't really thrilled about that either, right? So they're giving them lots of options to say, hey, don't worry, you can take the renminbi you end up with after we settle. You can convert it to gold, but if you don't want to hold it, in Shanghai, we get it. You can hold it in Abu Dhabi. You can hold it in wherever else you want.
Which is genius, because that really is one of at the heart of it. You're right, but the same thing could be said about the LBMA and the COMEX. Say what you want about the situation that was Venezuela, that has since obviously changed. But they said, "Can we have our gold back?" And the Bank of England said, "No, you can't." And the Bank of England was recognizing a leader that wasn't duly elected. That was a conflict. So no, you can't get it. And it was up to the Bank of England to make that decision. Doesn't matter what some of the countries recognized as who was running the country or not. The fact of the matter is, having it in multi-jurisdictions like this is certainly a step in the right direction. And when you talk about convertible, they've made the digital yuan convertible into gold for central banks. If you look at the unit settlement currency, it is 40% gold backed. It is operational right now, but they're all trading over things like SIPS, the cross interbank payment system, and mBridge, both of which are not compatible with SWIFT. All of this points to countries building their own infrastructure, strengthening their own monetary future, trading with one another, their local CBDC currencies. But to your point, being able to convert into gold immediately right now in Hong Kong and take possession. And this would be for central banks. But I see things moving in that direction. very much so. And I think that ultimately is much more so than the immediacy of the war, which has its own implications. The world is moving into a settlement system that will be dominated by local currencies trading over automated platforms like central bank digital currency platforms that are not compatible with SWIFT. And you look at how they are expanding. The Chinese just signed up the countries in Southeast Asia. The acronym is ASEAN, and they're 800 million people, twice the population of the United States, and they're already China's biggest trading partner by far. So this is a trend that is accelerating. And the most important part to think about this is that, you know, these countries will be able to settle outside the dollar. They will settle in their local currencies, which chips away at the settlement status of the dollar. But using gold as the ultimate de facto way to settle trade imbalances, to settle currency imbalances, it chips away at the reserve status of the dollar, because when you accumulate dollars to do global trade, you put the excess in reserves in treasuries. Both markets will ultimately be affected dramatically in favor of gold. And that's the beauty of the way the Chinese do things. They think in terms of decades, we think in terms of minutes. And they're setting up an infrastructure that once it is fully mature, not only will be massive tailwind for the price of gold, but it will also be, I think, a big headwind for the dollar and, more importantly, for the U.S. Treasury market.
Okay. All right. Well, so folks, keep your eye out for that video dropping on Tuesday morning with Peter Alexander there. Just a few more questions about the war, and then I want to get to another, relatively big announcement in the precious metals world. So you've said a number of times, Andy, that you have heard from people inside the military that our missiles basically require a lot of silver, and we and our ally in this war against Iran, Israel, are shooting off a ton of missiles, thousands and thousands of them. Is this something that will come back in the form of higher silver prices as they need to replenish all that in the future?
Absolutely. I mean, maybe that's part of the reason you got guys like Michael Widmer, who is the Bank of America's head of metals research, saying silver could reach anywhere between 135 and 309 by the end of this year. Maybe that's the reason that we've been seeing so much in the way of deliveries into the COMEX, month over month over month over month over month. Every single month, we are seeing massive deliveries coming into the COMEX. Maybe that's the reason, and for 16 straight months we've seen this, and maybe it's just coincidence that the government classified silver a critical mineral. Maybe it's a coincidence that they said we're going to implement something called Project Vault, which is a government-sponsored accumulation program of critical minerals, and of course, a stated government-sponsored price floor underneath critical minerals to incentivize domestic mining. Absolutely. There is no question, but it's not just the missiles, it's anything that is military. When you're talking hypersonic missiles, there are very few things on the planet that can withstand that type of temperature, heat on the cone. Silver is the best conductor, not only of light, but also of heat. And so it enables, and electricity. So it enables these missiles to travel at Mach 6, Mach 7, whatever it is, and still be very accurate. So yeah, there's no question, but that military is one of the big drivers of silver accumulation, and it's a depleting asset. It's disappearing. So I think there's a lot to say about the fact that the government front ran all of this by massive deliveries, massive accumulation, and then just coincidentally, it's now a critical mineral for national security. And I would argue, again, I don't know this is just a guess, but if it is for national security, the Exchange Stabilization Fund, which is run by the Treasury Secretary, has the ability to do all of this stuff without congressional approval. And when you look at the amount of metal that is coming in to the market or into the COMEX, that's extraordinary enough as is. But when you see the outflows of metal, that's something that no one's ever seen before. And I think it's important to understand when we look at the month of February, which was a non-delivery month, somewhere in the neighborhood of 25 million ounces were delivered into COMEX, which in and of itself is a lot. And every month for 16 months, we've seen roughly between 30 and 70 million ounces delivered into COMEX. How much is leaving the exchange? So in the month of February, we saw 25 million ounces or so delivered, but we saw 38 million ounces leave. Bye, goodbye, left COMEX. So who's doing that? That's about 2 million pounds of silver. Who's doing that? Where's it going? Who's arranging the logistics, the trucking, the insurance, and why leave COMEX? Where's it going? And so you have to ask yourself, to what level is the government involved in this? And I think it is a growing and expanding realization that silver is far more than industrial. It's critical on every level, not just for military, for AI infrastructure, for anything digital or electronic in a world that is moving in that direction. And a president that wants to, do things in a mercantile way where it's more about protecting the United States. Silver is critical, and there's no coincidence in my mind that all of this stuff is connected.
So I don't know if this is knowable, Andy, but could a potentially material part of the big withdrawals that were being taken, right, as some large players were standing for delivery from the COMEX, and you have surmised that these are probably sovereign entities, very well maybe the U.S. government. How much of that over the recent months could have been the government sort of stockpiling, knowing that it was likely going to go to war with Iran? And if it was part of it, is there a risk that demand going forward will be less because they were buying all this in advance?
Yeah, well, I don't think that that's a risk, because they've ignored this for years. We decimated our strategic stockpile, I don't know how many years ago. And so we're way behind the 8 ball there. You look at a country like India, who by all reports, and again, it's very difficult to piece this all together, but a lot of people think it's been well north of 800 million ounces that were accumulated by the Indians over the last several years. And I think it is absolutely non-coincidental. I think that the government has been behind this from the get-go. And I'd say the same thing about gold. I think someone within the Trump administration got to the president and said, this is what's happening around the world with gold and silver. And if we don't understand this and beat them at their own game, or get into it very, very, very aggressively right now, this country will be forever compromised. And so, I think it is. If I had to guess, I would say the Exchange Stabilization Fund has been involved in this really since the very beginning, because it's not just silver, it's also gold. Since a year ago, November, when he won the election, it's every single month. And just the other day, we saw 2.94 million ounces of silver loaded out in a single day. This is not business as usual. This is the kind of withdrawal that tells you physical metal is being pulled with urgency. And I don't know who's doing it, but it's certainly big.
Okay, and those it sounds like those volumes of withdrawal have not been diminishing. So even here in the first half of March, we're still seeing, kind of this very high level of withdrawal.
Absolutely. 2.9 million ounces in one day. Vault withdrawal is, I think it doesn't prove stress by itself, but it absolutely tells you it's more than just routine warehouse noise. This is way bigger than that. And I think we will continue to see that every single month. If past is prologue, we will continue. I just happen to think that this is a trend that will not stop.
Okay, but the demand for physical ounces, we've seen it rise to unprecedented levels, that you haven't seen in your career. It's still remaining at those levels, even though the paper price has been softening a bit, right? So at some point, one of those two things needs to win out, right?
Well, and I think that the paper price is the greatest tool of misdirection, and I don't think people quite understand that. And what I mean by that, let me try and give you what I mean by that. And let's use gold as kind of the proxy for understanding that. Gold is like, for example, GLD, which is a proxy for the price of gold. But to me, it's functioning more as a deliverable reservoir. And So what's interesting about it, the big interests in the US do not need to telegraph physical demand by bidding loudly in the open spot market, because that's what a lot of us can analyze. That's what we've been talking about. But what they can do, and these big money interests would be the APs, the authorized participants, JP, Goldman, et cetera, they can source GLD shares and redeem what's called baskets, which are 100,000 shares minimum, through their channels and receive
Right.
London good delivery bars. So
You and I can't do this, but these very big players can, right? Yeah.
right. And so what we saw recently was a very, very large redemption coming out of GLD. And it was like the largest redemption ever in its 20-year history. It was $4.2 billion worth of gold. It was a week or two in a single week, close to all-time high prices. But the largest weekly outflow in its 20-year history. Now, the media will frame that as this is, gold at the top, big money is repositioning. They don't trust gold anymore, but I look at it very differently. The combination of massive outflows while prices stay stable, and there's been a little bit of choppiness, but the prices have stayed relatively stable. This is exactly why I believe everyone has a right to be suspicious about this, because when price stays structurally strong, but ETFs are experiencing the largest, outflows ever in the history of the fund, to me, to the media, the interpretation is no one wants gold anymore. But to me, somebody wants bars more than they want the ETF exposure. And this is, to me, what is exactly happening, not just on COMEX, but they're doing the same thing in GLD and SLV, where they can create or redeem baskets, massive amounts, with a lot of, let's just say, a lack of transparency. And so what you see is the biggest money in the world pulling every single string they can to take physical possession. And you're seeing these outflows, not just in GLD, but in SLV too. And it's not as easily transparent like you would be if it were coming off the COMEX, which a lot of it would show up in the commitment of traders report and the outflow reports.
Okay. I'm just pulling from some questions here going through in the live chat. In addition to that, how much of the weakness, if any, recently in the precious metals, Andy, do you think is due to the fact that the stock market has been weak, and that people may be getting margin calls, in some of their positions, and when you get margin called, you just have to sell what has value? And so, we typically will see this if the markets really go into a sizable correction pretty quickly, which we haven't seen that level yet. But when that has happened historically, we usually see the precious metals go down initially with the markets because they're getting sold, and then they obviously recover usually before the markets do. Is that playing a factor here at all?
That's what we've always been told. And again, I go back to what Jim Sinclair and I talked about. That's mope, in my opinion. The conventional wisdom is throwing out the baby with the bathwater. And yes, you get liquidity. I have always felt that was just an excuse. Look, if it's a pretty much agreed upon assessment that the metals markets have been heavily managed, right? Call it what you want, manipulation or management, it's the same thing. Then the time to manage it is exactly when everyone is freaking out, because the last thing that they want to see is a dumping of dollars and an escalation of gold and silver, because it shines a light on the fragility of the entire system. And so, yes, we can call it throwing out the baby with the bathwater, getting liquidity. It's the most liquid. You can cover your margins. I don't believe that, because most of the people on margin, they don't have an ounce of gold to their name. To me, this is just managing the situation. So when you see the price dropping and the deliveries accelerating, it's almost as like, oh, are they just knocking down the paper price to quell that anxiety? At the same time, give it to me at subsidized prices.
Right,
It's
get the best deal they can.
Yes,
Yeah.
and it's like jacking up the margin rates, which squeezed all the speculators. The price collapses. And then you see huge deliveries, like the December delivery, which was the biggest December delivery in the history of the COMEX market for the month of December. You're seeing price really, I think, being misdirection from global demand and from the understanding that gold and silver would be the place to be. And if they're going to knock it down for you, great. We'll stand for delivery at a better price. To me, it's the opposite of what they want you to think. But what you said is conventional wisdom.
Okay. All right. I am going to, the other big topic I want to get to in just a moment is the CME margins. So we'll get to that in just a sec. I just want to pull up this comment here because True Texan was kind enough to pay to submit the comment. And he says, he asks, tell me one government you would trust to hold your gold. So Andy, if you had to put your faith in a government to not raid the vault that your gold was stored in, is there a government that tops the list? I mean, I'm going to guess maybe the U.S. because you've got your money in ring spots here. But yeah.
Yes, I mean, look, there still is the rule of law, but it depends how big of a, what are we talking? Are we talking physical gold held at Brinks? Sure. The U.S., I don't think will activate eminent domain. I think it would be far easier for them to go in and take SLV and GLD, which are controlled by JP Morgan and BlackRock, who JP paid the $920 million fine, the largest the Justice Department had ever issued at that point, for manipulating the metals market. It would be much easier for them to do that. I guess if I had to think of one country, and even they disappointed many years ago by closing out things with Viamet and all the Swiss banks, would be Switzerland. They have a history of that. But, the real issue is that I don't think any government these days is really trustworthy. This is why you get the old adage, if you don't hold it, you don't own it. But from a standpoint of building an ecosystem, if any of these countries are going to attempt to integrate gold into the monetary system, you get one chance, because the minute you deviate from transparency and trust, you're done. Mm-hmm. And I think that is, that's kind of the reasoning behind what China is trying to do by multi-jurisdictional vaulting in all throughout the Belt Road, which is not just China, it's Asia, it's Africa, it's South America, so that you have all of these vaults in the countries of all of the participants. So the next vault is being built in Saudi Arabia, and as is right now, Saudi Arabia can indeed sell their oil to China for digital yuan, and right now, which it's completed, is redeem those yuan immediately without going back into dollars. They're making it convertible without converting into dollars. Mm-hmm. In the Hong Kong branch of this new Shanghai Metals Exchange, the next one will be in their own backyard in Saudi Arabia. So who do you trust? I don't know. When all the chips are down, yes, I want to trust the U.S. I think Switzerland is a good choice, but I think that is why you're seeing, they see the same thing. That's why you're doing multi-jurisdictional vaults, and that's why the M-Bridge, their mm-hmm. Cross-border payment system, central bank cross-border payment system for the banks, the vaults are held in the jurisdiction of the countries that are involved. So if India were to have a node in this deal, they would have their own vault with their own gold inside the vault. And the idea is to sprinkle their gold around all of the vaults so that everyone has, their gold dispersed amongst the trading platform, if you will. It's a fair question, an answer that's impossible to get to, because desperate governments do desperate things. So how desperate can this get? I guess only time will tell, but I think that is the riddle they're all trying to solve, and certainly a good way to do so is by branching out your vaults into the participating network of countries that are involved in this new system.
Okay. Another question for you. This one's a little tangential, and I'll just take your quick best guess on this, understanding that there's a lot of unknowns here. I did an interview a little over a week ago, with a CEO of a graphene company. And I did that because I'd just been getting bombarded this year with viewers who were saying, hey, Adam, you got to do a video on graphene, and we think this is a great CEO to talk to. And the video was mostly just me asking her about graphene and its properties. And Andy, I don't know how much you've heard about it, but it's kind of this wonder material that does a whole lot of things, but it's 200 times stronger than steel. It can be manufactured at the atomic level, so literally one atom thick sheets of this thing. They also claim that it is the most conductive material ever discovered, which obviously caught my attention as a silver guy, because silver is the most conductive element that we know of right now. I did press her to say, hey, you mentioned it's 200 times stronger than steel. Do you have a multiple of how much more conductive than silver it is? She didn't have that at her fingertips. My question for you, Andy, is just, is there any concern in the silver world that you can detect from graphene eventually becoming a replacement for silver in all the commercial things that silver is used for right now for conductivity reasons?
I spend 3 hours a day, pretty much 7 days a week reading. And while I did come across that story, I have yet to see anything that even begins to show any concern for it. That doesn't mean it's not. And I'm reading everything I can on metals, on economics, on emerging technologies, whatnot. At this point, no, it's still pretty much off the radar, and I don't know. And that, again, I'm not an expert on graphene whatsoever, but I can tell you from what I see, it doesn't seem to be really on the forefront of the minds collectively.
So you're not hearing from inside the system people are worried about this as a threat, and from what I learned, and I'm no expert on graphene, it can't really be commercially produced at scale yet. And that's one of the reasons why this company folks were so excited about it, is they have technology that might eventually allow that. But we have gazillions of ounces of silver that we can pull out of the earth every year. We don't have that supply yet in graphene. So even if it does do what they say it can do, the supply just isn't there right now. Okay, so let's get to this other major topic. So you referenced, Andy, that as silver was vaulting above $100 an ounce, and gold gotten up to 5,000 an ounce, the CME started hiking the margin requirements for the precious metals. And that's kind of like pumping the brakes, right? It makes it harder and harder to hedge against these metals. And guys like you, it makes it much more expensive to buy insurance and whatnot. And so it's designed to cool off the froth, right? And we can maybe speculate that it worked, obviously, because the price hit a spike and it's still recovering from then. I think it was a week ago I saw, maybe a little bit longer, but the CME started it increased margins on oil to try to stop the froth in oil prices, but it lowered them in the precious metals. Does that send any sort of sign to you that it might be game back on for the march of the precious metals prices going forward?
Yeah, I mean, it also shows to me that there's record low open interest, that you've knocked out so much of the speculation. It's not just hedging the way that I use it. It is for hedging, but the way a speculator would look at it is, well, geez, because there was that period of time where silver was going up unabated week over week over week. So they would just buy contracts. And it's important to understand that one contract, COMEX, is 5,000 ounces. And right. So, again, I'm going back from memory, but sometime in like the beginning of December, to hold a 1 ounce or a one COMEX contract of 5,000 ounces, back then silver was about $60. $300,000 worth of silver would be controlled by, at the time, roughly only $15,000 in your margin account. So about 20 times leverage. By early January, we were up to over $50,000 or thereabouts in your margin account to control the same amount. And so if you are a speculator, forget about if you're a legitimate hedger or, for a producer, for a company like mine, for a refinery, all of those companies who have legitimate hedging concerns face the same consequences, where if you hold 2 million ounces in your warehouse, like we typically would at 5,000 ounces per contract and $50,000+ margin in your account that just sits there as collateral, you have to have $50 million in your margin account in order to have any type of inventory. That's just silver. Forget about gold and platinum. But if you are a speculator, well, you say, geez, we can control $300,000 worth of silver, and it keeps going up. Let's buy more. Let's buy more. Let's buy more. The day after Christmas, they jacked rates from by 30%, from 15 to 18,000, and then they did it again and again, and then all of a sudden it's $50,000+. And when they jack up margins, if you don't put that money into your margin account by the end of trading, bang, you're liquidated and they will close you out, which selling begets selling, begets selling, begets selling, the price craters. And then the big traders who aren't using margin, they come in and say, thank you very much. We're going to stand for delivery at these subsidized prices. So yes, it was certainly done to cool off speculation and froth because of all of the deliveries that we saw. And it started to create a problem. And it just goes to show the lengths at which the market will do what they can, at least in the COMEX, which is an exchange, versus the London Metals Exchange, which is not. It's a over the counter. It's dealer to dealer. What the lengths that they'll go to protect themselves, but every time they do that, you have to ask at what expense are they doing this? And the expense is lack of trust, and maybe that's why you're seeing the acceleration of deliveries. And I would argue more and more metal ultimately leaving the COMEX ecosystem. When you see 38 million ounces get on a armada of trucks and off they go, you have to understand that those bars, once they are put on that truck and leave, they are out of the ecosystem. In order to get reintroduced, they'd have to be assayed again at a big cost and a big time lag. They're never coming back. So yeah, I think all of this starts to creep into the reality that the Western price setting of these commodities, in my mind, ultimately is on a short leash and on a ticking time, ledger where I don't think that they have time on their side. I think ultimately we will see, for example, a BRICS exchange, which will try and, I mean, they're talking about building the grain exchange and they're talking about building the metals exchange that will compete with the price setting of the West. And I knew that a long time ago when 2-3 years ago they talked about building the grain exchange, and the gentleman in charge with it in the BRICS countries said, look, here in the global South, we produce and consume more grain than they do in the West, but we have no control over the price that's set on COMEX. And then he said something like, he says, but with the development of the BRICS grain exchange, that will change. Well, the same thing would change with the metals exchanges. And I think they've been using our stupidity in the way that we manage prices against us by standing for delivery. And that's really what's changed everything, Adam, in this entire system, is that no one ever stood for delivery. No one challenged the West. No one challenged hegemony. These countries were not coordinated. They were not motivated, sophisticated, wealthy, and they didn't have the incentive to do it. And they have been for years. That's what I focused on. And then all of a sudden, Trump wins. And what do you know? Those same motivations are appearing here. And I think it's accelerating as well. So you have the most well-informed traders on the globe. Forget well-funded central banks and very, very connected people who know the information. They always ask Wayne Gretzky, how are you so damn good? Well, I never skated to the puck. I skated to where it was going. And that's what these people are doing too.
All right. So a lot of questions here. First off, just real quick, if this is the average baseline for CME margins for precious metals, and they went up to some, extreme to cool off the froth, where are they now? Are they back to normal? Or are they somewhere in the middle?
They're more in the middle. They're not back to normal, but they are lowering them to get more speculation. That's one of the things that always blew my mind about the way the system worked. I mean, it was rinse, wash, and repeat. And the commercial banks would, suck in the speculators, whether it be through having virtually no margin requirements or very low margin requirements or letting the price rise, suck in the speculation, sell all of the options. They knew where the expiration dates were. They knew where the pain points were, and they would smack it leading into options expiration. The options would expire worthless. The big managed money that played this game rarely won. Maybe they'd give them a token win now and again to, give them the taste of victory and we can do this. And then bang, they would just pickpocket them every time. And it would start the process all over again. At some point, you're like, well, why don't they just stop participating in this game? Don't get in there and speculate. Don't give the commercial banks the ability to do this to you.
Right.
And when you see this record low open interest right now, where open interest is very low, meaning the contracts that are purchased by the speculators, by the managed money, the hedge funds, whatnot, it's very low. So let's lower rates more, margin rates more. Maybe we can suck them in. It's kind of the thought. Maybe some of these traders are finally waking up. to the fact that this is a game very difficult to win at that level. It's one thing to hedge your exposure. It's another thing to bet against or with or against what the price is going to be. And I think that's one of the reasons you're seeing them try to lower rates. But they haven't gone all the way back down yet, but they've certainly come down considerably.
Okay. And, Andy, when you talk about things like 38 million ounces withdrawn, right? We've talked about this before. Like, my mind just goes to, like, where is that going? Who's got the capacity to store that amount? How are they even transporting
you are who you
it?
are. But that's why you are who you are, because those are the things that matter, right? Who is taking it? A mint box of Silver Eagles weighs 42 pounds. It's 500 ounces. So who in God's green earth took almost 39 million ounces? It's over 2 million pounds. Well, who's taking it? How many trucks does it take to move that? Where's it going? Who's going to take possession of it? And can you imagine trying to unload that? It would take you all day with a whole group of vault attendants. But not only that, is it insured? Who's going to do that? These are all very, very, very important questions to ask, and it all comes back to someone who knows where the puck is going and has the ability to do this, where cost isn't even an issue. And that's the thing, is that rhetoric and seeing what they're really doing are detached. The rhetoric would tell you, the price, big outflows out of GLD. Yeah, no one wants gold anymore. Yet massive outflows of GLD. Well, what do you mean outflows? That's the same thing as share redemption, because the price didn't drop by those big outflows.
Right.
They're using every single trick in the book, in my mind, to take physical possession in a very private, clandestine manner, so as not to raise awareness. So yeah, who is taking it? People who are very sophisticated, people who are very wealthy and have the ability to not only run logistics and insurance, but, to your point, store it in a meaningful way. That's why I think it's the Exchange Stabilization Fund. Who could do this?
That's why you think it's governments, behind it.
Yes, because the Exchange Stabilization Fund can do these things if for national security. A critical mineral, by definition, is for national security. Shh, don't tell. I think that's what they're doing. Either that or it's Tesla and Samsung and Sony. But even still, why not just leave it in the vault and take it when you need it? And maybe some of that stuff that stays in the system are legitimate, manufacturing companies. But when it leaves, well, that's a whole different, ball of wax in and of itself.
Okay. When it's being withdrawn from the COMEX, that's happening here in the U.S., right? But it doesn't mean those ounces stay in the U.S., right? So it could be the Exchange Stabilization Fund, it could be the U.S. government storing this stuff in Fort Knox or under a mountain or something like that. But presumably it could be a foreign government taking delivery and then just putting it on a cargo plane and flying it to their country, correct?
Absolutely. Absolutely it could be. And we don't really know. That's one of the great mysteries. I think, we have to try and put all the dots together best we can. But when you see these deliveries for 16 straight months, when you see large outflow, and then realize, is it coincidence that Trump reclassified silver as a critical mineral? I don't know. You tell me. And I often go back to what the BIS did, where the Bundesbank said, give us back our gold. I've talked with you about this before. All of the central banks associated, Dutch, the Dutch bank, Austrian bank, the Czech bank, the Polish bank, the Bank of Hungary, Turkey, they all said the same thing, give us back our gold, from the Bank of England, the New York Fed in 2017, when no one was buying gold. In fact, they'd all been selling it. 2018, that number, those same countries bought more gold as a group than they did in the 60 years previously combined. Then they doubled that number in 2019, and then magically the BIS says, by the way, gold is now tier 1. If you think that's coincidental, I guess what I'm getting at is at that level, these big players not only strategize, but they take care of their own and tell them what to do well ahead of time. And so when you see this anomaly of deliveries in silver and in gold into the United States, and then you see things like this, it's leaving and it's now reclassified. And what Judy Shelton has talked about, at some point you have to understand that that's the only way to get this stuff done, is to front run where it ultimately goes. And you have to try and guess,
Is that the government or is it the Chinese government working with JP Morgan saying, give us the metal? Could be both.
Right.
I don't know, but it's certainly very unusual. It leads one to start thinking this way as well. Who the heck is doing this?
Got it. Okay. All right. So looking at the time, there are a couple key points I still want to get in before we wrap up, but we'll just chomp our way through
But
it.
Adam, one last point.
Yeah.
It doesn't matter who the hell is doing it. What it tells you is that the price, the dollar price isn't the issue. It's a physical possession,
Right.
and physical accumulation is worth more than the dollars that are valuing it.
So
Whoever's taking it.
Great point, and that's been a common theme throughout my discussions here with you. Is at the end of the day, what matters is possession. Here is at some point in time, when and if the music does stop, it's not going to matter what the price is. It's just going to matter is who's got how many ounces. Yeah,
Correct. That's right.
Okay, so you've talked in the past about how China has I don't know what percentage, but a very large percentage of the world's refining capacity for the precious metals, and that recently it was called an export ban. I don't think it's a 100% blockade of refined metals leaving their country anymore, but they basically said, look, it's going to get harder, or we're going to let less metals that come into our country go back out. The U.S., as I understand it, is really sort of fast tracking precious metals refining here domestically. In your mind, how long will it take for us to be able to ramp that up to any meaningful level where we can start, giving the rest of the world an alternative to having to send their stuff to China?
Hopefully pretty soon. That's why you see them build that $4 billion smelter as well. It's not just precious metals, it's rare earths as well. They refine pretty damn close to 100% of all the rare earths as well. And again, this is national security.
And sorry to interrupt, I just don't know. Is it just as easy to refine rare earth minerals as it is precious metals, or is one easier to refine than the other? I get the sense that rare earth refining is a lot tougher, or else we wouldn't be in this pickle that we're in globally versus China. But I could be wrong.
I don't know either, but I will tell you that doré bar, which is the bar, a crudely refined bar that the miners will pull out, China is responsible for refining doré. About 70% was the number that I saw. Between 65 and 70% of the doré bars that are refined are actually refined in Switzerland. And then, in China, and a lot of those bars then would be sent to places like Switzerland to break them down into smaller units and whatnot in places like Argo Herreras or Valcambi or Pampa or whatnot. But they're huge in it. But it's also important to realize that everyone focuses on that. That was kind of the retaliation, if you will, to the United States classifying silver critical. And people forget the European Union did it a year and a half ago, same thing. But what people miss is in November, China came out and said, listen, we're the second largest producer of silver in the world. If you ask David Morgan, he would tell you, he was told when he went to China and visited some mines, they said, we're number one, not number two. But wherever it is, they're very, very, very significantly producing silver in their country. And they came out in November and said, listen, the stuff that we mine will be primarily for domestic use. And so you're seeing not only the Chinese not sending any silver out to the world, but they want to reduce and curtail the amount of doré refining that goes out as well. So again, yes, all of this points to a realization that there is a race to having the real thing versus the system that the West set up, which is about paper pricing and creating this, I guess, this distortion of value through the West being able to control the price. That's ending. Yeah. That to me is ultimately ending, is what this is largely about.
Okay. But in terms of sort of the supremacy of the physical ounces, right? Part of the whole Monroe Doctrine 2.0 vision is, we create much more incentive for the Western Hemisphere to trade amongst itself. And as you've said, right now, much of the doré in South America is going to China. We ramp up our our refining capabilities here in the U.S., and we come up with enough trade deals in total that make it worth their while. Presumably, we're trying to make sure that a lot of that South American doré goes north to us now rather than east to China, correct?
Well, and you talk about how the Chinese, I said, look, they think in terms of decades. So, okay, we're reactionary. What have they been doing the last several years? Well, they've been flying to Mexico, to Peru, number 1 and 3 largest producers in the world, China number 2. If you're the number 2 largest producer in the world and everyone sends you your bars, your doré bars to refine stuff, and the price has done nothing, then why fly all around South America and to Mexico and say to these countries, listen, we'll pay you double what the West will for your doré and your concentrate, which is a byproduct sludge, and we'll send it back to China and refine it. Why would they do that if silver was just something that didn't matter? They are way ahead of us in thinking this way, way ahead of us. They've been mining gold and silver for years that was uneconomical, using our trade imbalance to do it. And now they're like, you know what, we are the first or second largest producer in the world. Let's go to 1 and 3 and get their stuff too. Because we can refine it and we can pay more than the West will because we have more spare cash with this trade imbalance. And it's a good way to de-dollarize at the same time. They're choking on dollars and treasuries. So unload that for things that are tangible that we need. Doesn't matter what the price. It's kind of like the large premium we see in Shanghai right now. And again, you know, I've researched it and dug deep into it, and the VAT tax is the responsibility of the recipient primarily when it leaves the exchange, not the guy delivering it or the company delivering it. And so, yeah, normally arbitrage like we see in Shanghai would disappear quickly. It hasn't. It's like 13% plus the 13% VAT tax. You're talking 25% more they're willing to pay in dollar terms than the Western price truly is, because this is a race for the real thing. More than anything, that's what you can see if you take a step back and say, that's what they're doing. Price be damned, they don't care. They want to get rid of these dollars slowly instead of dumping them. Buy things that you need, and that silver in their possession is worth way more than the dollars that they use to buy.
You have to respect the jujitsu there, which is, you know, a lot of people for many decades have said, oh my God, the Americans, you know, have had this exorbitant privilege and they get to send, you know, their paper to the East and buy real things, right? Get all this, you know, stuff from Walmart and stuff like that, right? And those, you know, dumb Chinese are stuck with all the paper, right? But they then jujitsu that and said, all right, we're going to use that excess paper to buy like the things that have persistent wealth, right? Yeah,
that's right.
That we're now waking up to the fact that, hey, that's a lot more valuable than the cheap crap we were getting. Yeah,
totally. And you can also see that by them not rolling over their treasuries like they once did. Instead, they're taking it and putting it into the Belt Road, putting it into the infrastructure, putting it into the exchanges and all of the infrastructure that allows them, when it is fully mature, to be one hell of a worthy adversary on certain levels. And again, they do things in a cooperative manner. You see the United States going around with a stick. They go around all these countries, even by the name of their Shanghai Cooperation Organization, the largest regional financial and military organization on the planet. BRICS is fully voluntary and cooperational, and there are no mandates that a country has to live by. They set it up so that the presidency rotates every year. All of these things are pointing towards cooperation rather than coercion. These are the things that ultimately debase and devalue the incentive for holding dollars and treasuries. They can be taken from you, they can be manipulated, they inflate the hell out of their currency, yada, yada, yada. And the other countries just quietly laugh, build infrastructure, buy natural resources, and control the natural resources. And that's what they are attempting to quietly do. And it takes a long time. It's the lack of immediacy that people dismiss all of this because, well, it didn't happen like that. We live in a world where everything is instant gratification isn't fast enough. They don't. And when they are fully mature in their aspirations and their intentions, they will be formidable as hell. And I think you can see it if you take a step back and see what they're actually strategically doing.
Okay. All right, Andy, we started a few minutes late, and that was my fault. If you don't mind, we'll just go just a few minutes over the hour.
No sweat, buddy. Yep.
Okay, so this one, just a super quick answer, because you could give me a real long answer, and
I usually do. I'll try not to.
No, that's all right. But let's assume for a moment, we have no idea if it's going to happen, but let's assume for a moment that the Iran war wraps up in the next 2-ish weeks. right? Um, how much? What would you expect that to do to the price of the precious metals? Is there some, war premium that's in them right now that's keeping the price a little bit higher than it might otherwise be right now? And would you expect them to drop with the announcement of a peace or ceasefire, or do you not see a war premium in them?
Well, what MOPE again, management of perception economics, that's exactly what they would try to do, is knock it down, not let it go higher when we expect it to, knock it down when we do expect it to, because that
Mhm.
reinforces, it's just you don't need metals. They don't do what they're supposed to do. This is the West being able to control perception. I would expect it to take, instantly that Sunday night when it's over. Yeah, they would knock it down and say, see, the dollar is in control again. It doesn't change a damn thing. It doesn't, because everything that's happened up to this point, long before there was this issue, I think explains that this is a race. And if they have the ability to control the narrative, paint the tape, they will. And that would be an opportunity where they would want it to fall, versus managing it from rising being a different thing. When we think it should rise, we go to war on a Friday night. Well, come Monday morning, Sunday night, the price is going to be way higher. Knock it down to delink that rationale, make it counterintuitive, frustrate the market. I would expect it to fall temporarily, but I think what will betray that will be, you will see wicked deliveries again, because the big money says, thank you very much for that.
Mhm.
We'll stand for delivery while everyone is looking the other direction.
All right. Well, and Andy, I mean, that is what I am doing, right? I'm not a massive sovereign player, right? But I'm doing my own little, all right, if you can't beat them, join them. Whereas you have always recommended to viewers, and I know your father instilled in you at a young age, which is just have a regular program where you just buy and keep accumulating, and you use, if there really is any intentional suppression going on, you use that to your long-term benefit, right? And the way I sort of think about my physical ounces is it's just a form of savings. It's just a form of savings that's out of the banking system. In many ways, it's the Bank of Taggart that I'm creating, right? And I have more confidence personally in that the purchasing power of what I put in that bank sustaining versus dollars that I'm just putting in, Wells Fargo or Citibank or whatever, right? So if they do knock it down, yeah, the overall market value of my holdings go down in the near term. But as an accumulator, I say, hey, that's great, because I've got confidence that it's going to be higher at some point in the future. And right now I can buy in at lower prices in my regular purchasing. I'm presuming you think that's probably a pretty good way to think about it, but
1,000%. I mean, and that's 1,000%. Saving in dollars is disastrous. It has the lasting value capacity of a melting ice cube. And I often use this example, but you can choose any asset. And I've said this on your show before, but for people who didn't hear it, look, the wisdom of holding your wealth in your excess cash in gold, to me, is extraordinary. But let me just show you quickly. 2005, I can pick any number, but I've said this so many times on podcasts, I remember it. 2005, the average price of a house in the country was $240,000. Gold was $455 average price in 2005. That's 510 ounces or thereabouts. You could have used that 510 ounces to pay off the house. You don't. You put it under your mattress, earning nothing but dust. And that's what, the financial, well, it doesn't pay any yield. Why would you own it? Okay, fair enough. The house has doubled. Today it's 500,000. Great investment. You did well, right? But those 510 ounces today times roughly $5,200 or whatever, you're talking $2.6, $2.7 million, which buys you 5 fully furnished houses. So your house doubled in dollar terms. It lost 500% or more in gold terms. In other words, the dollar is falling faster than assets are appreciating. Gold is what exposes that. So yes, I think the most important thing to do, whatever you do, is realize that the very, very wealthy people, they hold their wealth in assets. Assets will feed you. Liabilities, which is what a dollar is, will eat you. And if you hold your wealth in dollars, yeah, you don't see your dollar value going down, but what you will see is that the purchasing power is getting crushed. And that's the thing that's harder to see unless you look at any asset in ounces of gold. In other words, easier said, in dollar terms, assets have been going up. In gold terms, those same assets have been going down because gold is holding its value better than the dollar we measured values in is evaporating. That's the important lesson. So yes,
All right.
that's how I hold my gold too.
Okay, that calculus with the house price, it's very convincing. That's a really great one to use. An average person can really grok what you're talking about that when you put it in those terms. All right, Andy, so I just want to put this up. This comment, totally unsolicited, was put up in the first few minutes of this discussion. Just letting everybody know I bought some stuff from Miles Franklin and everything worked great, just how it was supposed to. So I always love getting these reports from people who have actually transacted with you, Andy, because obviously we send a lot of people to you, and you guys do take great care of them, as that gentleman just showed. So in a moment, I want to get to the status of the current special offer that you've made available to the folks here at Thoughtful Money. Real quick, this might put you on the spot a little bit, and I apologize for that, but I think it's going to be instructive for folks. So earlier we were talking about hedging, right, and how the cost of hedging gets impacted by the margin requirements of the CME.
Yep.
But hedging is very important in this business. And really, Andy, what I want to give you an opportunity to do here briefly is just explain to people how Miles Franklin and its practices are better and more worth a consumer's confidence than, say, a firm like Tolving, right, which basically went out of business because it was, as I understand it, unhedged, and the price of the metals basically got away from the guy who was buying for his own book, and basically this thing imploded overnight. And that's certainly not the only one, but I remember at the time a lot of people who had bought from Tolving and had outstanding orders just being totally left in the lurch. So talk about what you do and your team does at Miles Franklin to reduce your firm's vulnerabilities to price action that you don't suspect.
Well, Hannes Tolving was an interesting guy. I'd met him before, and I think in this industry, when you see companies that are materially cheaper than every other major company, it's a massive red flag. Whether you're talking Tolving, whether you're talking, I don't want to get it was in Austin, Texas, and it was bullion. There's Northwest Territorial Mint up in Oregon, I think it was. There was bullion.
I have some of their bars.
Or Washington. There was bullion. There's a company called Bullion Direct now that's legit. I don't remember. There was bullion something in Austin, Texas. But they were all three of these companies, and Hannes and Tolving, were materially cheaper than everybody else. And when we all buy from the same sources, when we all are trying to be competitive and yet stay in business, that's what business is, mutual beneficial relationship. We make money, we're here when you need us, you get a good price and have a chance to succeed. Yes, Hannes got way over his skis for sure. I don't know what he was doing he went to jail, so obviously it was something that was considered egregious. But I think the telltale sign is that you want to work with companies that are very fairly priced, that have a good reputation, and are not the cheapest company by a long shot. That's right. When things start to become because he was selling stuff for what the rest of us delivered overnight for what the rest of us were paying things for. And I was, this ain't right. This isn't right. This won't end well.
Yeah, so and I believe near the end, he was taking incoming orders to then use to buy the inventory to then pay,
that's
people
a Ponzi
who had already
scheme.
placed orders, right?
That's the definition of a Ponzi scheme. But that's what what kind of a business model is it where you are so far undercutting everyone else in an environment where, there's only so low you can go. And we all know what everybody pays. We all buy from the same mints and the same refineries.
And it's a very small margin business, your business, right? Yeah, because so how do you, because you are competitive on pricing, and you always invite the viewers to reach out to you to get your latest price list. But how do you manage to do that while still, ensuring the ongoing solvency of your company.
Yeah, and it's also getting a lot more expensive to ship things, and it's becoming very, very expensive. You just do lots of volume, Adam, and that's the truth of it. You have to do lots of volume, and that's what led there to be this group of companies, that now Tucker Carlson is exposing, that I have tried to expose for a long time with having guys on my channel like Dale Whitaker, with doing it professionally without mentioning the companies. I could rattle off 10 of them right now, but I don't. But simply to say, these companies that create a story and sell stuff at huge premiums in order to not do the huge volume. If you are going to, that's why there's a handful of companies out there, big online companies that dominate the market. And I think you will see a consolidation, probably fewer and fewer alternatives out there. How
Does
do
that
you
mean
do
you
it? There is,
expect consumers to get burned as some of those players
yeah, absolutely.
collapse?
Some will crap out, others will be gobbled up legitimately. But it's yes, you have to hedge your exposure, and at the same time, you have to do things right and do lots and lots and lots of volume, and that's the truth of it. In order to survive in this environment, and as the price goes higher, it'll be almost impossible for the local coin shops to keep up. It'll be almost impossible for the small dealers that don't hedge to do anything with safety.
Mhm.
And if you don't hedge and the price fell like we saw when they jacked up margins by, this colossal 30%, you're out of business. And if you're not, you are in big trouble, because if you lose 30% on the massive inventory and you're only making 2% on your sales, well, that's not a model that's going to last very long. So yeah, hedging is important. But I think the biggest sign is either very high priced coins that you've never heard of before
Right.
with some story behind it, or a company that is so materially lower than everybody else in price, all the majors, it ain't worth it. It just isn't worth it. There's only so low you can go.
Okay. So obviously, folks, if you're in the business now, Alpha Money endorses Andy, but whomever you buy from, look for a player that, I would say has been in business for at least a decade, right? So they're not some fly-by-night operation that just set themselves up, and that they have a brand to protect. But look for a company that does hedge and does enough volume that that they're going to, you've got confidence that they're solvent. And then lastly, if you're getting a price that seems too good to be true, and you've got to order, look, if you can walk out the door with it that day, sure, buy it, right? But if it's something where you got to place your order and then you got to wait a couple of weeks, that's where the danger really comes in. And so just be very careful of that, as Andy has said. All right, Andy, well, look, as we wrap up here, last time we had you on, you very kindly, not only extended the offer of buying junk silver from your firm at a good discount, but you improved the offer again, and you had to change it a bit because of some of these CME margin hikes. But your last update to it was letting this audience buy it at 99 cents, or essentially $1 below spot, while supplies last. What's the status of that? Are supplies still lasting? Is that still available? Do you need to make any tweaks based upon what's happened recently in the markets?
Let me look at my phone real quick. Don't mean to be disrespectful, but let me just see. I'm certain that number is still good, but I want to see if it's actually a little better than that, which I
Oh my
might be
goodness.
able to do. Let me
I'm
see.
happy to tap dance that. If you're going to maybe get folks a better offer here, I'll do whatever it takes to give you the time you need.
Yeah, here it comes. Let's see. Where is it? 90.
Yeah,
I can do it. I can do it at $1.50 back a spot. Still, $1.50 back a spot. Look,
wow.
I've never seen a value like this in 90% junk silver, ever, never. And it's important to understand that for 3.5 years during the pandemic, I would have paid you $9 over spot for it. The premiums, nothing compared to pre-65 silver in terms of performance other than Silver Eagles. So until it changes, I can do it at $1.50 back a spot. For your listeners, and I will continue to try and do that. I have gone out and bought as much of it as I can, and some people think I'm crazy. For me, I can hedge it and buy it back a spot. Why not? It's never been like this. It's an anomaly. And sometimes distortions and anomalies and and the disruptions can stay that way longer than people can stay solvent, I think it's a no-brainer. So yeah, we have a lot of it, and it is $1.50 back a spot for now.
Wow. Andy, thank you so much. And by the way, just to be super clear, when you say backup spot, you mean $1.50
per
under
ounce,
spot, right?
per ounce.
Yeah,
Yep.
per ounce, under spot.
I've never
Okay.
said that about anything ever, never, including 1,000-ounce bars, nothing, never. What is the downside? Well, the market changes forever. Don't think so. I have to believe that someone somewhere got a whole lot of crap for doing what they did with the margin hikes, because it really messed up the refiners, which are a massive source of liquidity to the industry. But they don't just deal with the precious metals industry. Refining is a lot bigger than that in industry. And so I would be surprised if you see margin hikes quite like what we saw recently, which in many respects got many of the U.S. banks maybe largely on sides. We'll see. But yeah, I think it's one of these deals where if I were going to speculate a little bit, I would say, what do you got to lose when the refiners finally do open back up and are moving in an efficient manner again? Yeah, I would suspect premiums will certainly rise considerably on the pre-65. It's a no-brainer to me. Not something I would want to do if I had a 6-month time frame, but if I'm buying this and putting it away, I don't know that there's a better buy.
All right, and that was the key thing I wanted to underscore here. So a big reason why Andy is able to give such a great discount, Andy, correct me if I'm saying anything wrong, it's because the refiners are so backed up and swamped right now. And so, presumably that will change at some point in time, and then the premiums on junk silver will rise again, and therefore you're buying at what seems to be a really great moment in time here. But to Andy's point, yes, Andy, the market could change forever in some way we don't expect. That's a risk here, probably a pretty low one. The other one is I would not take advantage of this offer expecting to then turn around next week and sell this, right? Because the refineries are backed up still, and so the folks aren't going to want to buy it from you at the historical premium they used to. But if you're planning on holding this for a material of time, we don't know how long, but as Andy said, maybe 6 months, a couple of years, odds are quite good over that time frame that the pricing will, for selling it will become a lot more attractive again. And again, in general, our general advice when it comes to buying physical ounces is this is stuff you don't want to be trading anyways. This is stuff you want to be buying and holding for a long period of time.
100%. That's the way I look at it. Unless it's, that's 36 years worth of experience I have saying that this is really weird, like never happened before weird. It got its name junk silver, Adam, because typically back in the day, I could buy it for maybe 20 cents back a spot, way back when no one was buying it, and sell it for 25 cents over spot. This is when silver was, $7-8 an ounce or whatever. And then we saw during the pandemic where everyone wanted it, and I would have paid you $9 over spot, and it was being sold everywhere in the country for 10 or 11 over. As big of an anomaly as that was, this is the exact same thing. So yeah, I think the further away you get from long-term averages in anything, whether it be temperature, whether it be, your favorite baseball player who gets 600 at bats in Major League season bats 900 for the month of April. There's only been one baseball player in the modern era that finished at 400 the last day of the season, Ted Williams. You could bet everything you own that player will be closer to 300 than to 900 at the end of the season, and you'd win, right? At least history shows you that. Well, it's the same thing here. Long-term averages, the farther you get away, the greater the magneticism that regresses you to the mean. And I would say this is an anomaly in every sense of the word. So yes, if you have time on your side, you're putting away silver for your family, whatever it is, this is a bet I would take.
All right. And just one thing to note on, I've mentioned in the past with junk silver, is it gets scarcer over time, meaning they're not making any more of these coins. There's not necessarily a big collectible factor to this. In fact, there's not much at all, which is why it's called junk silver. If you've got if you're buying this for your kids or whatever and hoping that they're going to hold it for, a good chunk of their lifetime, it's not like more junk silver supply is ever going to come on the market. It's always going to get a little bit less year after year as this stuff gets refined into a different form.
Yeah. I mean, let's just make the order really big so you can understand. You buy $1 million worth of the stuff, you're getting $1 million and you'd pay $7, $8, or $9 over to get American Eagles. Well, you're getting $12 an ounce back a spot difference. I mean, $12 back of American Eagles difference on $1 million. That's a lot of silver.
Yeah.
So yes, it does make sense if your time horizon is long enough to warrant holding it, understanding it's never been this way. So unless the rules have been rewritten, which I have no reason to believe they have, this is just one of those weird times in history where the distortion has affected all the way down the line. Because if these small dealers that don't hedge would normally send it to a refiner and get spot for it, well, you know, if the refiners aren't taking it, what do? They need cash. They can't hold it. So the big houses that make the market, well, they're like, well, you know what? We're way back a spot to buy that from you. Take it or leave it. And what do? They sell it. Well, if those big houses are going to sell it to me for just a little bit more than they paid for it, back a spot, I'm in. I'll take everything you'll sell me. And all to the coin shops. We have a network of 50 or more coin shops that I've worked with for decades that will call me and say, hey, will you take it? I'll take it all. Send it to me and just put me on speed dial anytime it comes in. We'll take it all and we'll pay you instantly, because to me, it's a bet worth taking.
All right. Well, look, folks, first off, please thank Andy. If you're watching this in the live, please thank him in the live chat, or if you're watching the replay, thank him in the comment section below, both for coming on a Sunday and answering all the questions I've tossed at him, but also for continuing to extend and improve this special offer for silver that he's been so generous to make exclusive to the Thoughtful Money audience. And obviously, if you want to take advantage of the offer, you probably want to know where to go. So go to thoughtfulmoney.com/gold. Or actually, I'm sorry, that is the wrong one. I'm pulling up old stuff here. Go to thoughtfulmoney.com/buygold. And even though it says buy gold, it also applies to silver. Go to thoughtfulmoney.com/buygold. There's a very short form to fill out there. It'll take you all of 4 seconds. And as soon as you fill that out, Andy's team will get in touch with you. And if you're interested in this offer, they'll help you think it through and fulfill it for you. But if you also just have other questions about buying, selling, storing precious metals, they're there to help as well. And Andy, I just want to say thank you so much for how well you've treated this audience. The comment there we got from the gentleman that I showed a few minutes ago, I get those all the time. It really lets me sleep well at night to know that I'm doing business with a firm that treats its customers as well as yours does.
I really appreciate it. One last thing. I know you and I are both very close with Rick Rule. He's been on your show. For those of you out there who want to work with Battle Bank and their programs, Rick has integrated his programs into all of my Brinks facilities. Important to mention one other thing: if you want our price list, ask for it. We print it. Don't look at the prices on the website as being what our prices are. They only go up to a small amount. We will be as competitive or more so than anyone. And if you find prices that you think are a little better, let us know. We'll do our best we can. And that's in comparing our price sheet with current prices, which we only update twice a week. But we will do our best to see that not only that your people get white glove service and attentiveness, but also the best we can to make sure we'll never be undersold. And little things like storage and the ability to access Battle Bank's lending program and all of these things that are happening, including some other very exciting things that are coming that we hope to talk about soon. We want to offer to your people first and foremost. So I appreciate being here, Adam. And this is for the St. Patty's Day vibe that is all over the place now. So it's always a pleasure to come here, even on a weekend.
Got my green on too, brother. All right. Well, look, Andy, can't thank you enough. Folks, as a reminder, Andy will be one of the featured speakers at Thoughtful Money's Spring Online Conference, which will be next Saturday, March 21st. If you haven't bought your ticket yet and want to go, I would highly recommend going right now to thoughtfulmoney.com/conference, because today, Sunday that we're airing this, is the last day to buy at the last chance to save price before the price bumps up to full price. And I'd love for everybody to get the lowest price that they can for this. If you're a premium subscriber to our Substack, check your email. You have a code for me you can use to get an additional $50 off of that. When Andy comes on, it's going to be live there as well, and he'll give us whatever update has happened in the precious metal space. But also that's there, it's a forum there just to get as many user questions in front of Andy as we can. So if you've got some burning questions, you got a pretty good odds that we'll get it in front of Andy and he can answer it there for you. But Andy, my friend, again, I just thank you so much for everything.
Got it.
Folks, if you want to go take advantage of that offer, again, don't forget to go to thoughtfulmoney.com/buygold. And Andy, I'll see you in a week, but thanks in advance for all the people you're going to help between now and then.
My pleasure, Adam. Thanks for having me. Look forward to chatting with everyone next week.
All right. And everybody else, thanks so much for watching.